What happens if I hold a futures contract until expiration? In recent news, many investors are asking a pressing question. What happens if I hold a futures contract until expiration? With the current market fluctuations, understanding this topic is more important than ever. Futures contracts can be a key part of your investment strategy, but knowing the implications of holding them until the end is essential. When you hold a futures contract until expiration, the outcome varies based on the contract type and settlement terms. There are two main scenarios to consider. First, if the contract specifies physical delivery, you may need to deliver the actual commodity if you are short. Conversely, if you are long, you will take delivery of the commodity. This means that the contract settles through the exchange of the physical asset, like barrels of oil or bushels of wheat. The second scenario involves cash settlement. Many futures contracts, especially those related to financial markets or certain commodities, settle in cash. At expiration, you will either pay or receive the difference between the contract price and the final settlement price. This final price is typically based on the spot price or index value at the expiration date. In this case, no physical exchange of the commodity occurs. Most investors do not hold futures contracts to expiration. They often close out their positions by making offsetting trades before the contract expires. This helps avoid the complexities and costs associated with physical delivery. The final settlement price is determined by the exchange and is often based on the closing price or a volume-weighted average price of the underlying asset. Futures contracts are marked to market daily, meaning gains and losses are settled each day through margin accounts. By expiration, the contract value converges to the spot price of the underlying asset. If you do not close your position before expiration and the contract requires physical delivery, you must be ready to manage the logistics and costs involved. For cash-settled contracts, your final profit or loss will be the difference between the contract price and the settlement price, settled in cash shortly after expiration. Understanding whether a futures contract is physically settled or cash settled is vital for managing risks and planning your exit strategy at expiration. With the market's current volatility, this knowledge could be key to your investment decisions.